Every time you tap your phone at a coffee shop, swipe at a gas station, or click checkout on a website, there's a good chance a company in Purchase, New York just made a fraction of a penny. And those fractions add up to almost $33 billion a year.
That's the beauty of the toll booth model. Mastercard doesn't lend you money, doesn't take on credit risk, doesn't even issue a single card. They just sit at the center of the network and collect a fee every time value moves through it.
Today on Charged Alpha, we're breaking down Mastercard, ticker MA, one of the most consistently profitable businesses on the planet. Episode 68, let's get into it. So Mastercard was founded back in 1966, originally as the Interbank Card Association, a group of banks that wanted to compete with what would eventually become Visa. Headquarters are in Purchase, New York, about 40,000 employees globally. They operate in more than 200 countries and territories.
And the business model is elegant in its simplicity. Mastercard runs a two-sided network connecting card issuers, the banks that give you a Mastercard, with merchants who accept it. They make money three ways: transaction processing fees, assessment fees based on gross dollar volume flowing through the network, and cross-border fees when you use your card internationally.
That last one is a big deal. Cross-border fees are the highest margin revenue stream, and international travel has been surging. Q4 2025 showed 14% year-over-year growth in cross-border volume alone.
What's changed in recent years is the second engine. Mastercard now generates 41% of revenue, about $13.3 billion, from what they call value-added services. That's fraud prevention, data analytics, digital authentication, cybersecurity, and that segment grew 23% last year, nearly double the rate of the core payments business.
So they're not just a payments network anymore. They're becoming a payments technology platform.
Exactly, and that strategic pivot is what makes them interesting right now. The industry is shifting towards stablecoins, real-time payments, agentic commerce, and Mastercard is positioning itself at the center of all of it.
Running the show is Michael Miebach, who took over as CEO in January 2021. He's German-born, studied business economics at the University of Passau, did the advanced management program at Harvard. Before Mastercard, he spent 13 years at Citibank in senior roles across multiple countries.
He joined Mastercard in 2010 to lead their Middle East and Africa operations, became Chief Product Officer in 2016, then President in 2020, before stepping into the top job. So he's been inside the company for over 15 years. He knows the machine.
And his track record speaks for itself. Under Miebach, value-added services has gone from a side business to 41% of total revenue. He's expanded into open banking, digital identity, and real-time payments. The stock is up meaningfully since he took over.
All right, let's talk numbers. And there are a lot of good numbers to talk about here. Starting with valuation, Mastercard trades at $506 a share, putting the market cap at $440 billion. The trailing PE is 29.9, forward PE around 26.5. Price to sales is 14.1 times.
Those are premium multiples. How does that stack up historically?
It's actually right around the 5-year average for Mastercard. The market has consistently been willing to pay up for this level of profitability and growth consistency. Now, revenue, trailing 12 months came in at $32.8 billion, up 16.4% year over year. EPS was $16.54.
And the margins are where this business really shines.
Gross margin, 79.4%. Operating margin, 55.9%. Net margin, around 46%. These are some of the highest margins in the entire S&P 500.
That's software company territory.
Better than most software companies, actually. And the cash flow picture is equally strong. Operating cash flow came in at $17.7 billion, free cash flow at $16.4 billion. Capital expenditures were just $489 million. That's the asset-light model at work. They generate enormous cash without needing to reinvest heavily.
What about the balance sheet?
Cash on hand is $10.6 billion. Total debt is $19.8 billion, so you've got a net debt position of about $9 billion. The debt-to-equity ratio looks high at 245%. But that's somewhat misleading because Mastercard has been aggressive with share buybacks, which reduces equity. Interest coverage is 26 times, which means they can easily service the debt from operating cash flow. Dividend yield is about 0.7%. Modest, but they've increased it 15 consecutive years.
And they're buying back shares aggressively on top of that.
Overall, Mastercard's financial health is strong. High margins, massive cash generation, consistent double-digit growth, and very manageable debt relative to their earning power.
So what does Wall Street think? Analysts are overwhelmingly bullish. 30 analysts cover the stock. 27 have buy ratings, 3 holds, 0 sells. The average price target is $6.59, which implies about 30% upside from current levels.
The range runs from $500 on the low end to $756 on the high end. Morgan Stanley has an overweight rating with a 720 target. They see value-added services as underappreciated. Goldman Sachs is at 680, citing cross-border recovery as a key driver. JP Morgan is at 650, calling it a best-in-class payments franchise with secular tailwinds.
Last earnings dropped January 29th. Q4 2025 revenue came in at $8.81 billion, up 18% year over year. Adjusted EPS was $4.76, up 25%, beat on both top and bottom line.
And the guidance was encouraging. Management pointed to the high end of low double-digit net revenue growth for 2026 on a currency-neutral basis, operating expenses growing at the low end of low double digits, which implies continued margin expansion, tax rate in the 20 to 21% range.
So let's lay out the bull case. Number 1, cross-border payments. Global cross-border volumes are projected to exceed $250 trillion by 2027. That's a massive tailwind for Mastercard's highest margin revenue stream, and they're already seeing 14% growth.
Number 2, value-added services. This segment is growing at 23% and now represents 41% of revenue. These are higher margin, stickier revenue streams: fraud detection, analytics, authentication. Once a bank integrates Mastercard's fraud platform, they don't switch easily.
Number 3, the crypto and stablecoin opportunity. Regulatory clarity is emerging, and Mastercard's Crypto Partner Program is connecting digital assets to their global payments infrastructure. If stablecoins become a mainstream settlement layer, Mastercard wants to be the on-ramp.
And number 4, real-time payments and financial inclusion. Their transaction stream technology enables same-day clearing and settlement. Partnerships like the one with Ericsson are expanding digital money movement in emerging markets where hundreds of millions of people are coming online for the first time.
All right, Lana, hit me with the bear case.
The bears have some legitimate concerns. First, regulatory risk is real and growing. The DOJ has an active antitrust case against Mastercard and Visa. The UK's Competition Appeal Tribunal has already ruled against multilateral interchange fees, and the Credit Card Competition Act was reintroduced in January 2026 with bipartisan support and executive branch backing.
If that passes, what happens?
It would mandate routing competition for large banks, meaning merchants could choose which network processes their transactions. That could pressure the economics of exclusive network arrangements. It's not a death blow, but it would create pricing pressure. Second bear concern: the Capital One Discover merger. If approved, it creates the first vertically integrated issuer network competitor in over 40 years. That's a real competitive threat.
And technology disruption.
That's the third concern. Digital wallets, real-time payment rails, potential central bank digital currencies, any of these could theoretically route around traditional card networks. The question is whether Mastercard can adapt faster than these alternatives can scale. And fourth, valuation. At 30 times earnings and 14 times sales, there's not a lot of room for disappointment. Any growth deceleration could compress that multiple quickly.
Let's see how Mastercard stacks up against the competition. The obvious comparison is Visa, which trades at a similar 31 times earnings. Visa is bigger, $41 billion in revenue versus Mastercard's $33 billion, but Mastercard has been growing slightly faster, 16% versus Visa's 12%.
American Express is a different animal. They trade at just 20 times earnings because their integrated model carries credit risk. much lower PS ratio at 2.5 times, reflecting the lending revenue. And then there's PayPal at just 8.5 times earnings, but that's because growth has turned negative and the branded checkout business is struggling.
So Mastercard sits in that sweet spot, premium valuation justified by premium growth and margins.
Right? You're paying up for the best combination of growth, profitability, and competitive positioning in the payment space.
On the options front, the put-call ratio sits at 0.8 on an open interest basis, which is below the 52-week average of 0.9. That's a modestly bullish reading. Call open interest is clustering around 520, 550, and 600 strikes for the May through September expirations.
What's interesting is the implied volatility skew. Puts are pricing at 53% IV versus 23% for calls in the May expiration. That suggests some institutional hedging against downside risk, likely tied to regulatory uncertainty, but the overall positioning still leans bullish.
Worth noting, options activity alone doesn't tell you direction, but the combination of low put-call ratio and call clustering near analyst targets suggests the options market broadly agrees with the bullish consensus. Inside the building, it's been all selling, 24 transactions in the past 6 months, 0 purchases.
Before anyone panics, context matters here. The vast majority of those sales came from CFO Sachin Mehra, 23 sales totaling about 42,000 shares worth roughly $24.5 million. But these are routine dispositions tied to stock award vesting and options exercises. This is compensation management, not a vote of no confidence.
No insider buys, though.
That's typical for companies with heavy stock-based compensation. Executives are already heavily exposed to the stock through their compensation packages. The absence of open market purchases isn't unusual here.
All right, let's talk risks and watch points. The big one is regulation. The Credit Card Competition Act, the DOJ case, UK interchange rulings. There's a lot of regulatory activity aimed squarely at card network economics.
The key metric to watch there is net revenue per transaction. If regulators force routing competition or cap interchange, that's where you'll see the impact first. The other watch point is value-added services growth. If that segment decelerates below 20%, the growth narrative weakens.
And on the catalyst side, cross-border volume trends in the next couple of quarters will be telling. If we see that 14% growth sustain or accelerate, the stock likely moves toward analyst targets.
Currency impacts too. The 2026 guidance includes a 1 to 1.5% FX tailwind. If the dollar weakens further, that's incremental upside to reported numbers.
So here's the bottom line on Mastercard. This is one of the most dominant business models in the world. A toll booth on global commerce with nearly 80% gross margins, 56% operating margins, and $16 billion in free cash flow. The growth engine is firing on multiple cylinders, and the strategic pivot into value-added services is working.
The risks are real: regulation, competition, and a premium valuation that demands continued execution. But the financial profile is exceptional, the competitive moat is wide, and the secular trends in digital payments provide a long runway. The key metric to watch going forward: value-added services as a percentage of total revenue. If that keeps climbing, Mastercard's transformation story stays intact.
Michael Miebach, the CEO of Mastercard, put it well. He said, "People want simplicity. They also want safety. Our job is to deliver both at the speed of digital commerce." And when you look at the numbers, that's exactly what they're doing.
It's a concise framing for a business that processes billions of transactions across 200 countries. Simple to use, hard to build, harder to replicate.
That's going to do it for episode 68 of Charged Alpha, the S&P 500 Stock Encyclopedia. If you found this deep dive valuable, subscribe wherever you listen so you don't miss the next one. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.